Welcome back to the MPowered Finance Podcast with your host, Sid Misra, Certified Financial Planner. Thank you for tuning in. This week's episode is on education planning. This is episode 5 of the podcast. And I've been getting a lot of questions about education planning, how to approach it. We work on that with our clients, but I thought I'd do an episode on this specifically to just talk about what you need to be considering, what you need to be thinking about, and how you should go about making a decision on how you're going to fund college or higher education for your kids. 80% of families, when I was looking into this, this is a number from JP Morgan, 80% of families say that higher education is an investment into their child's future, and it's also part of the American dream. They think that getting a degree, a bachelor's degree, a master's degree, whatever it is, higher education, it opens more doors for those students. You're able to earn more money with a college degree. I'm not here to be for or against college. I think that there's, pluses and minuses and pros and cons to that side. I'm just here to talk about the process of planning for it, what you need to be considering and thinking about. There is a reality that a lot of jobs require you to have at least a bachelor's degree. I may agree with that, may not agree with that, depending on the job. But at the end of the day, that's kind of how the rules are, right? And so you're not going to be able to change that. If you want a seat at the table, you have to end up playing by those rules. But I think it's important to do that in a way that makes sense for you and doesn't put you in a financial bind and doesn't prohibit you from accomplishing things later on in life. So in starting this, I was just looking at some of the costs that families have to account for when they're college planning. On average, in 2019, families spent about $30,000 on college costs, and almost half of that came from their income and savings. It was about 45% came from the income and savings of the parents. And so that's a big chunk of the money that they have. It's a lot of money to be putting towards an education. Again, it's important to have a plan. It's important to understand how you're going to approach this because it is, again, a lot of money. And again, the importance of a plan. So again, in the research that I was doing for this episode, according to Sally May, those that have a plan have, on average, about 2 times more funds to help pay for college than those who don't. So planning in itself is going to help you get the money to pay for college. And then also on the other side, for the debt side, right, those who plan on average can expect almost 50% less student loan debt. Student loan debt, we all know someone who has student loan debt. You may yourself have that and be paying what equates to, let's say, a mortgage payment or a rent payment just towards that. So we understand what that does. Trying to lessen that burden is going to be a big help to people in the long run. Having a plan doesn't mean you're just mindlessly adding money to an account, kind of hoping that it gets you to your goals. You may end up, saving and growing your money, but it probably won't be enough. It won't have been efficient. It won't have been, what you could have accomplished if you had a plan. And so having that plan allows you to utilize your time more wisely and effectively, allows you to be more intentional about your approach and the money that you're going to commit to paying for this cost. It is super important. And whether you do it with a financial advisor, whether you do it by yourself, have a plan. Having a plan is so important. So the first thing you have to figure out when you're making this plan for college is figuring out what the expenses are. Um, College is not cheap, obviously, as we all know, and it would stink to, not be able to afford it, not be able to afford the school that you want to because you were not able to plan ahead. And to that point, up to on average, about 70% of families have to rule out certain colleges because of the costs. It could be a private school, public school, in-state, out-of-state, whatever it may be. But imagine getting into your dream school or your child getting into their dream school and not being able to go because you just can't afford it, right? You don't want them to miss out on that because you didn't plan. So again, what is needed? The costs, obviously, it's going to cover tuition, room and board. If you're living there, if you're commuting, then there are some other costs involved. Other expenses, fees. There's fees for everything. There's a parking fee. There's a fee for signing up for classes. I mean, I think colleges are utilizing fees as a way to raise more money for themselves without raising tuition officially. So there's always going to be fees for those types of things. Just kind of nickel and diming in the system. So those are some of the main costs, right? Then you also have to look at the choice of school that you're going to. Public versus private. I mean, there is a huge difference between that. There's a huge difference even in the public sector, right? In-state versus out-of-state. But for example, 2020 to 2021, the average public college costs were about $23,000 to $24,000. For private, and that was for in-state. For private, it was nearly double that. It was about 48,000. It's double. It's $48,000 for private school. So you can see how big of a difference that is. It's a big difference for 1 year. Imagine for 4 years, right? Over the course of on average, how long it takes to get a bachelor's degree, right? Thinking about how much more it is over 1 year than over 4 years, how much more you need to plan for. It's a lot, right? Then you also factor in the option of possibly going to community college. And the average for that is actually about $4,000 to $7,000 a year, which, again, compare that with the other two choices, public and private. Think about that on a year-to-year basis. Think about that cumulatively for the 2 years that you're in community college. That could help alleviate some of the burden. But those are huge costs. And to the point about a bachelor's in 4 years, almost 60% of students do not earn their bachelor within 4 years. So you have a super senior, you have super seniors, 5-6 years to graduate. And so you can imagine how much those costs can be if you're adding on even more. If are you able to handle that and be able to pay for that? And so you can't just think about the costs now because college costs are rising every single year. You have to start thinking about costs for when your child is going to college. If you have a newborn right now, that means college is in 18 years, right? Think about how much college has gone up since you went to college, since your friends or a younger sibling went to college, right? Costs have gone up in that amount of time. Think about how much it's going to go up in 2 decades, right? So we have to factor in inflation to the plan of how you're going to actually pay for college. The cost now versus when they actually go to school. And just kind of going off of some of the numbers here. So inflation is the rising price of, or the rising cost of goods and services, right? The goods we consume, the services that we take and we consume as well. I'll give you a couple of examples. Inflation rate for food, and these are averages. Numbers may be different depending on the methodology for figuring this out, but food, for example, 2.5%, gas, 2 to 2.5%, inflation for housing, 2.8%, travel between 2 and 2.5%. The inflation rate for college has, on average, been about 6% per year. which is which is crazy. You look at the inflation rates for the other things, and we all see that, right? We all see gases going up. We see the rent and food costs are going up. We see that, but think about college being 3 times as much, or 2 to 2.5 times as much. That's a crazy amount, and so you have to account for that. If you don't account for that in 18 years and 15 years, whatever that may be, you get to a point where what you've put away and what it's grown into is not going to be enough. You haven't calculated inflation or used inflation in your calculations, and so you're going to end up being short. You're going to have to make that up somewhere. So inflation on the cost of what it is going to be a huge drag on what you're going to be planning for. And then again, to this point about not having enough, not college costs being more, there is also a disconnect between what families expect to pay and what they actually end up paying. And so for families, on average, they expect to get from scholarships and grants, student loans, et cetera, they expect to get a certain amount. They expect to be able to get about 60 to 70% of the tuition from those amounts. And then, maybe they out of pocket spend about 30 to 40%. And that comes from their own, income sources, maybe investments that they have. And then the rest of it can come from, these student loans and grants and scholarships. That's the expectation. Unfortunately, the reality is over 50% ends up coming from their income and their investments. We're looking at 50 or 60% coming from money that should be set aside for parents' retirements. It should be income that's used to help the family live. More than half is going towards college education, and only the remainder is coming from grants and student loans and things like that, which, it means that one, parents are having to make up that difference, and then two, parents are also hurting kind of their futures. And I'll be going to that later on within this podcast episode. So just looking at it on a year-by-year basis, right, 2018 to 2019, families paid about 43% of college costs from their income and investments. 2019 to 2020, that number went over 50%. It was about 52%. So there is a disconnect there. There is a shortfall that is not being provided. College costs keep going up every year. The aid that is available, the assistance that's available is basically staying the same. And you're competing now with, more people and also working against rising college costs. And I think to this point, I just kind of want to bring up, and this is something that you as a parent, you as someone who's planning for college, need to figure out and take into account. Is college worth it? Is this cost worth it? Again, certain jobs require it. Again, there are studies that show you can, make more money over your lifetime, have more job opportunities, but is it worth it at this particular price? Is it worth it at the cost of 4 years of public university in-state, public university out-of-state? Is it worth it in terms of 4 years of private college tuition, right? It may be worth it, but it may not be worth it at that price point. And so that is something that you have to take into account and consider while you're doing this, right? And so one of the biggest things is how much can I actually, or how do I actually pay for it? If you've decided, how much you're looking to put in and how much you want to contribute to your child's college, the next step is, okay, like how do I actually get to that number, right? And you have to put your money to work. So I came across an interesting stat. It's kind of sad, actually, but 50% of families that are saving for college currently are only using savings accounts or certificates of deposits or very, very safe investments that are safe, don't have a lot of risk of going down, but do not generate enough return. The average savings account return is less than 1%, right? If going back to our previous point, if inflation is for college costs is 6% and the account that you're getting is only returning less than 1, you're losing out. You're losing purchasing power out. The money that you end up having will only go so far. It's only going to get you a little bit. It's not going to get you what it once did, right? So you can't just save and stock money away. You have to put that money to work. You have to invest it. That money needs to be working in the market as hard as you do. A quick example of kind of the power of the market and just kind of tracking the U.S. economy and the markets as well. Since 1983 to 2020, right, rolling 18-year periods. So that means 1983 to 2001, 1984 to 2002, 1985 to 2003, right, rolling 18-year periods. Stocks averaged an annual return of about 11%, right? 11%. If inflation is for education is about 6%, you're still beating that. Even with fees, whatever it may be, you're still beating that. You have to stay invested. You have to handle the volatility, the ups and downs, but you are rewarded in the long term for keeping your money there, for adding to it and letting the market do its job. And you have to be able to use that to your advantage. One of the biggest things is time. Time is probably one of the best determinants of success. If you can utilize time effectively and use it to your advantage, you can really kind of harness the power of compound interest. So think about, if you have a newborn, right? They're going to college in 18 years, almost 2 decades. Think about the previous stat about the rolling 18-year periods, 11% return over that time. And that's an average. It's not guaranteed. There are ups and downs and depends on when and how much when you got in and all that. But think about the time frame. You can afford to take on more risk. You can afford to put your money to work. If you continuously add to that and you're diligent about doing that over 18 years, that'll be a good amount of money to be able to use to help fund your child's college. I also think too to the using time to your advantage, make it automatic, right? I'm going to be talking about 529 plans in a little bit in this episode, but they're the most common funding vehicle and saving kind of planning vehicle for college. Nearly $1 in $3, right? Almost 33% of all the money going into 529 plans is automatically transferred from a bank account, right? So just like, when you contribute to your company 401k or whatever the retirement plan is, that money is going in automatically. You're not really seeing it. 1/3 of the people that use 529 plans transfer it automatically from their bank account. Once a month, every paycheck, whenever, but it's a constantly recurring thing. Kind of set it, not necessarily forget it, but you're setting it and consistently adding to it. So you're using your time frame, you have the habit of adding money to it, and over time people see a lot of success with that. So we talked about investing, putting your money to work, utilizing equities and stocks and trying to capture the gains of the markets. It's not just about stocks versus bonds, being aggressive, your asset allocation. It's about the location as well. There are different accounts that can help with the funding and paying of college. There's no perfect account, right? But for your situation, for your needs, for what you're trying to accomplish, some accounts may be better than others. And I'm going to go through a few of them real quick. They're different funding vehicles. The first couple are used sometimes, but really people use kind of the latter two. And so the first one is a custodial account where you as an adult would own it on behalf of your child, or whoever is the beneficiary of the minor. And basically, there's no real tax benefit to that. Investment earnings are taxed. The child gets the account, access and control of it when they turn 18 or 21, depending on the state. And so they can choose to use the money for whatever they want. If they want to, blow it all on Atlantic City or Vegas or something like that, there's really not much you can do, because when they get to that age of majority, it's theirs. And that money, because it's not in kind of a specialized account for education or a retirement account for a retirement, it counts towards financial aid. It has a high impact on financial aid. I don't see a lot of people using that, but you can. The next one is, I have seen a few people use Roth IRA money if they don't need it for college costs. Your principal in a Roth is always available to you. That was funded with after-tax dollars. And if you take the money out before 59 and a half, but you use it for education, you will pay taxes on gains, but there's no penalty for doing that because it's for education. It's also not included in, the FAFSA, but withdrawals from that account will count towards income for the year as well. And so those first two that I mentioned, Roth IRA, which is a retirement account, and a custodial account, are used sometimes, but not as often as the other two. The last one, which is a 529, is the most common. I've saved that for last. But the next one is a Coverdell education savings account. Only about 6% of parents who are saving for college use these accounts. It's owned by the parent for the benefit of the child. Tax-free investing and withdrawals for qualified education expenses. So things like tuition, room and board, books and supplies, laptops, computers, right? Because we're very digital now. You have to contribute before that beneficiary turns 18, and you generally have to use the assets before 30. There are some income limits, and also the contribution limits are pretty low, only $2,000 per child per year, but it does have a low impact on financial aid. And so some people use that, but the 529 plan, which I'm going to be talking about right now, is probably the most used, the most well-known and recognized. About 50% of parents who are saving for college use a 529 plan owned by the parent for the benefit of the child. And there are two kinds. There's a prepaid and savings. I'm going to focus on the savings, which is the most popular. And what that is you're putting your money into it. You pick the investments within there, and it's tax-free investing. The withdrawals are tax-free if used for qualified expenses, education expenses again. So tuition, room and board, books and supplies, special needs services, computer-related equipment, some apprentice programs as well, and some K through 12 education. And so what's interesting about these accounts is the account owner, right, usually the parent for the benefit of the child, the account owner has control of the account for life. So if your child decides not to go to college, if they don't need the money, you can, as the owner, change the beneficiary, maybe to your other child, maybe to a niece and nephew, cousin, whoever it is that you would like to help pay for education expenses, you can change it to them. What's also cool is you could change it to yourself, right? You can help keep yourself up to date on continuing education and training for your job to make sure that you are as attractive to employers as possible, and you are staying up to date on your training and things like that. It's a great way to help pay for your own training. No income limits on contributions or age restrictions on the beneficiaries. Again, it's for life. You can just name a new beneficiary if they don't use it. The contributions are much higher than the 2K for a Coverdell. There's really no limit. I think up to like $500,000 is the contribution limit. But you can put that really any amount in. Estate tax wise, there is a gifting limit of $15,000 per year per beneficiary. So if you have a child, right, a couple can give 15 each or $30,000 to that child, tax and estate planning consequence free, and that can go into their 529 plan. You can even do actually 5 years all at once. And so if you have the cash, a windfall like an inheritance or something, you could do the 5 years all at once. So 15 times 5, you could do $75,000 for a beneficiary for one person to contribute. For a couple, then that means 75 each if you do the 5 years all in once. And that may be a great way to kind of pre-fund stuff and get it into the account by the time, let's say, they turn 18. Hopefully that's grown into a good amount there. 529s have a low impact on financial aid, and there may be some state tax benefits to that. A lot of these 529 plans, the states run them, and the states use specific fund companies. So, for example, Virginia is an American Funds plan. I forget what New Jersey is, but some states will give you a state tax benefit for using the 529 in your specific state. There may be a stipulation that you go to a state school within the state. I know New Jersey doesn't offer that, but some states do. So just definitely check that out. And again, that is the most common one used for tuition fees, room and board, books and supplies, special needs services, things like that. That is a way for you to, invest your money. It's an account for you to put it in. It has the tax benefits that are available, and it gives you access to investments to grow your money. And then again, when we talk about paying for school, there's also financial aid, and that's something that you're going to have to search for, apply for the Fafsa, go through the whole process of doing that, but there is aid available. And so the free application for federal student aid was what Fafsa stands for. There's a website there that you can go through. It gives you all the information on how to apply, what things that you need, what kind of documents, when you're supposed to apply by. But it does help give you access to aid if you want federal student loans and things like that. In 2019, only 71% of families who were had students going to college, only 71% filed a FAFSA. And a few years before that, it was about 80%. So for whatever reason, people are just not taking advantage of what's available. I would absolutely, try to take advantage of that. Go in there, fill out a FAFSA, give all the information, and see what kind of aid you can get. So required for federal help, they're going to be looking at things like your income as a whole, right? There is a thing called an EFC, expected family contribution. Some of your assets are going to be counted towards that. And so, as a parent, right, they're going to look at some of your gross income above a certain amount. They're going to look at up to about 5.7% of non-retirement assets. So, 529 plans, investments, savings. And then if you have for your kids, they'll also look at income if they're working and earning income, and then 20% of their assets, which include those custodial accounts. So again, if you go back into the earlier part of this episode, I mentioned that custodial accounts are included, and you don't get any sort of break from federal student loan kind of looking at that. 20% of those assets would be included, which is a lot more than the 5.7 of a 529 plan. I've actually had this question asked to me. 0% of the assets from an income from grandparents would be counted towards that. I've had some people ask me about that. Grandparents' income and assets does not count towards that. And that total expected family contribution is used to calculate how much aid your family and that student or your student would be expected to receive. And so this is another area where planning is going to be helpful. If they're looking at things like income above a certain amount, they're looking at non-retirement accounts that you may own. If you're planning, it may shed some light on situations that would be beneficial to you or not beneficial to you, right? Maybe it's beneficial if you're getting a bonus to defer that, right, while they're looking at your income, because that's going to count against you and towards that expected family contribution. If you can avoid taking, investment income and things like that, planning around that to avoid capital gains and things like that being added to that expected family contribution, right? That's where planning comes in. You're not just looking at college, you're looking at college as it pertains to your larger financial picture. But the real reality is too, while you're trying to get this aid, the percent of families getting grants has gone down. The percent of families getting scholarships has gone down. There are more people trying to get that money. There is less money available, and college costs are going up. So it's still very difficult to get in a lot of cases, but go apply, put the work in to do that, because you probably save yourself a lot of money. And then loans, right? Loans are another way of funding college. It's probably the most common way, taking out a loan. The average balance for student loans is for students, about $25,000 to $30,000. But what's interesting is the average balance for college loans for parents is about $25,000 to $30,000. And so parents are taking out parent loans, or they're co-signing loans to help their kids. These loans cost money. Interest rates are not cheap and are not low. And so it takes a long time to pay them off. Like I mentioned before earlier, some of these, I have clients that are paying $1,200, $1,300, $1,400 a month in student loan payments. That's, a partial rent payment or, a mortgage right there. That's a lot of money that could be going to other things. So I think it's important, while we've gone over the costs and looking at inflation and looking at how much, possibly you can get from financial aid and what it would take to save and the accounts and all that, I think it's really important, again, to look at the priorities, right? How much do you want to pay? How much are you willing to pay? Unfortunately, what we see is nearly 40% of Americans, adults, use the money that they set aside for retirement, for their own retirement, to pay for a child's education. And that is a huge, it's a big mistake, right? There's a thing, yes, you want to help your kids out and provide for them, but not at your own detriment and not at your own expense. We've all flown and we've traveled, and you've been in the airplane when they talk about, in case of an emergency, the oxygen mask will drop. Put on your own mask before you help others. And that's something here that I want you to remember, right? Your child, the student that you're planning for can get a loan. They can find grants. They can work and pay their way through school. No one is giving you a loan for your retirement. No one is giving you a grant for your retirement. That is all on you. There is really no other way to fund your retirement other than what you are putting away for yourself. And the reality is, too, that every dollar that you use for college that comes away from your retirement account is actually several dollars less for retirement. It's not just dollar for dollar, because you're missing out on the time it's invested in the years of earning compound interest. That money would make money. And so if you're using it now for college versus letting it grow, you're missing out on a lot more. And so it's very, very important. It'll be very key for you to figure out how much you want to pay. Very similar to my previous episode of what is your number? If you're a pre-retiree, what number do you need to retire and live comfortably? Set this number, figure it out. And once you have that, start working backwards to figure out, how do you get there? And, we've talked about the cost. We've talked about how tough it is for families to pay for college. Again, figure out if it's worth it. Is it worth it to go to this 4-year private school, or is it worth it to go to an out-of-state or even an in-state school for 4 years when you could possibly go to community college for 2 years and get your associates, right, your 2-year degree, and then go to a proper program to get your 4-year bachelor's degree? Is it worth it in terms of how much debt you're taking on, right? Think about the years that you're going to be paying this off. It's very easy for a college student who's 18 to just say, yeah, I'll take out the loans for it, but they're not thinking, in another 18 years, they'll still be paying for it, right? There are benefits to getting a college degree, but like any other major decision, there's also an opportunity cost. And so if you do decide to go to college, do planning, right? If you do decide to help pay for your kids' college, plan for it. Understand the actual costs, understand what it would cost to do 4 years at a private school, 4 years at an out-of-state public, in-state public, 2 years at community college, and then 2 years at the other places. Figure out what those costs are. Figure out what inflation is going to make those costs look like in the 10 or 15 years they have until they go to college. Figure out how you're going to pay for it. How much money can you actually afford to put towards this cost, and how much are you willing to do? Otherwise you'll get into the situation where there's not enough money. Your kid ends up taking the loan, or you end up taking money from your future to pay for their present college costs. So again, just plan for it. Take some time to put this to paper. Really, really figure out what you're trying to accomplish. And if you have questions, ask somebody. It's worth having someone take a look at it, a professional, just to figure out if you're on track, to help you come up with a plan if you need to. And then also probably to help you avoid making a bad mistake like taking money out of your retirement. It's a little bit longer episode here, almost twice as long as the other ones, but there's a lot going on with college planning. And so I wanted to make sure I covered the bases. This is still even just kind of a big 30,000 foot overview of what goes into it. At the end of the day, the plan that you come up with has to be tailored towards you, your goals, and what you can do financially, what you're capable of doing. This is just a starting point, and I hope it's given you some ideas on how to approach the education planning part of your finances. Again, thank you again for tuning in. Stay tuned for the next episode, and thank you so much for your support. Take care.